Listen up because this is big. Japan just hit the brakes on its easy money era, and the tremors are being felt across the globe. For years, Japan's central bank kept interest rates at rock bottom levels. This flood of cheap money spilled into the global economy. Now, that spigot is tightening. This unexpected move sent shockwaves through global markets. Stocks tumbled, currencies went haywire, and investors everywhere are scrambling for answers. Why is Japan doing this now, and what does it mean for your money? The answer, my friends, is that the game has changed. Japan's decision signals a major shift in the global financial landscape. The era of easy money is coming to an end, and investors need to be prepared for a bumpier ride ahead. But don't panic. In this wild world of investing, knowledge is power. So buckle up because we're about to break down everything you need to know about Japan's rate hike and what it means for your portfolio. For years, Japan has been the king of cheap money. The country's economic strategy has long been characterized by its ultra-low interest rates. The Bank of Japan, or BOJ, has kept interest rates super low, trying to jumpstart their economy. This approach was aimed at combating deflation and stimulating growth. This strategy, known as quantitative easing, flooded the world with cheap yen. By purchasing large amounts of government bonds and other financial assets, the BOJ injected liquidity into the market. Think of it like turning on a fire hose of cash. This massive influx of money was intended to encourage borrowing and spending. This flood of yen had a ripple effect across the globe. It wasn't just Japan that felt the impact. International markets were also influenced. It made its way into all sorts of assets, from stocks and bonds to real estate and commodities. Investors around the world took advantage of the cheap yen to diversify their portfolios. Investors, hungry for yield, piled into riskier and riskier investments. The search for higher returns led to increased speculation and risk-taking. But every party has to end sometime. The era of easy money can't last forever, and the consequences of such policies eventually catch up. Japan is grappling with rising inflation, just like the rest of the world. The cost of goods and services is increasing, putting pressure on consumers and businesses alike. The BOJ's rate hike is a clear signal. The era of easy money is over. By raising interest rates, the BOJ aims to curb inflation and stabilize the economy. This is a big deal, folks. The shift in monetary policy marks a significant change in Japan's economic landscape. It's like Japan just turned off the music and flicked on the lights. The sudden change has left many investors and market participants scrambling to adjust. The party's over, and it's time to sober up. The days of easy money and high-risk investments are coming to an end. Investors who got used to the punch bowl being constantly refilled are in for a rude awakening. The new economic reality will require a more cautious and strategic approach to investing. Hold on tight because Japan's rate hike has sent shockwaves through every corner of the financial markets. This unexpected move has left investors and analysts scrambling to reassess their strategies and predictions. Let's start with stocks. Global stock markets, already on edge, reacted to Japan's news like a spooked horse. The volatility was palpable, with indices swinging wildly as traders tried to make sense of the new landscape. The Nikkei, Japan's main stock index, took a nosedive. Investors rushed to sell off their holdings, fearing further declines. The sharp drop was a clear indication of the market's anxiety. But it's not just Japan. US stocks, European markets, you name it, they all felt the heat. The ripple effect was immediate, with major indices around the world showing significant losses. Why? Because investors are worried that Japan's move signals a broader global shift away from easy money. The era of low interest rates and abundant liquidity might be coming to an end, and that has everyone on edge. Now let's talk currencies. The Japanese yen surged against the US dollar and other major currencies. This caught many off guard, leading to a flurry of activity in the forex markets. Think about it. Higher interest rates in Japan make the yen more attractive to hold. Investors are now looking at the yen as a safer bet, leading to increased demand and a stronger currency. And finally, bonds. Remember, bond prices move inversely to interest rates. This fundamental principle is now playing out on a global scale, so as rates rise, bond prices fall. Investors are now reevaluating their bond portfolios, leading to widespread sell-offs and declining prices. And that's exactly what we saw, a global bond market sell-off. The impact was felt across the board, with both government and corporate bonds taking a hit. The bottom line is this: Japan's rate hike is a seismic event in the financial world. It's not just a local issue, it's a global phenomenon that has far-reaching implications. It's a wake-up call that the rules of the game are changing. Investors and analysts alike will need to adapt to this new reality, rethinking their strategies and preparing for a more volatile market environment. Japan's surprising rate hike isn't just about market swings. It's a loud warning about the global economy. Remember the I word, inflation. It's back, and it's causing headaches for policymakers everywhere. See, Japan's easy money policies, while intended to stimulate their economy, also contributed to the global rise in inflation. Cheap money flowing across borders fueled demand, pushing prices higher. Now the BOJ is trying to put the brakes on inflation before it spirals out of control. But here's the catch. 22. Raising interest rates can also slow economic growth. It's a delicate balancing act. Japan's rate hike throws a wrench into the works of the global economy, which is already teetering on the edge. The big fear is that Japan's move could trigger a wave of similar actions from other central banks. If everyone slams on the brakes at the same time, it could send the global economy into a tailspin. So, what does this mean for you? Buckle up, because we're in for a bumpy ride. Inflation is likely to stick around for a while. Economic growth could slow down, and the markets get ready for more volatility. Japan's decision to raise interest rates is a significant shift from its long-standing policy of keeping rates low to encourage borrowing and spending. This move is seen as a necessary step to combat the rising inflation that has been plaguing not just Japan but economies worldwide. The ripple effects of this decision are being felt across global markets, with investors reacting to the potential for tighter monetary policies in other major economies. The interconnectedness of today's financial systems means that a policy change in one country can have far-reaching implications. Central banks around the world are closely monitoring Japan's actions. If they follow suit and raise their own interest rates, we could see a global tightening of monetary policy. This could lead to higher borrowing costs for consumers and businesses, potentially slowing down economic activity. On the other hand, if central banks decide to maintain their current policies, they risk allowing inflation to continue rising, which could erode purchasing power and savings. The challenge for policymakers is to find the right balance between controlling inflation and supporting economic growth. This is no easy task, as the two goals can often be at odds with each other. For Japan, the decision to raise rates is a gamble that could pay off if it successfully curbs inflation without stifling economic growth. However, the outcome is far from certain, and the global economy is watching closely. For the average person, these high-level economic decisions can seem distant and abstract, but the reality is that they have a direct impact on everyday life. Higher rates can mean more expensive loans and mortgages, making it harder for people to buy homes or finance major purchases. Inflation can lead to higher prices for goods and services, stretching household budgets thinner. The volatility in financial markets can affect retirement savings and investment portfolios, adding another layer of uncertainty. As we navigate these turbulent economic waters, it's important to stay informed and be prepared for potential changes, keeping an eye on central bank policies, understanding how they affect the economy, and making informed financial decisions can help mitigate some of the risks. While the future is uncertain, being proactive and adaptable can make a significant difference. In conclusion, Japan's rate hike is more than just a domestic issue. It's a signal that the global economic landscape is shifting. The actions of central banks in response to this move will shape the economic environment for years to come. Whether it's through higher interest rates, continued inflation, or market volatility, the effects will be felt by individuals and businesses alike. So, as we brace for the impact, remember to stay informed, be prepared, and navigate these changes with caution. The road ahead may be uncertain, but understanding the factors at play can help us better prepare for whatever comes next. Buckle up, because we're in for a bumpy ride. Inflation is likely to stick around for a while. Economic growth could slow down, and the markets get ready for more volatility. The global economy is at a crossroads, and the decisions made today will have lasting impacts. Stay informed, stay prepared, and navigate these changes with caution. Want to stay updated on the latest market trends and investment insights? Subscribe to our channel for more in-depth analysis. Let me know your thoughts on Japan's interest rate hike in the comments below.